Hey everyone, sorry about that. I had trouble unmuting my mic. We just got the closing bell for Thursday, July 18th, and we had quite a bit of action today. I was expecting more of a chop sideways, but what we got was a very strong continuation of that downward movement. We didn't gap, but we just traded straight down. So the relative movement from the gap to the bottom right here yesterday is about the same as what we got today. So that's a very strong downward movement. And we actually came and tested that EMA 20 today. So moved a lot faster than we expected. And that means there is a lot of downward pressure. And maybe so far today, at least, that EMA 20 held. We did come down through it almost to this 550 level. So the top of this box. So our key levels are at the top of this box, the middle of the box, and the bottom of the box. We came and tested the top of the box, and we closed just a little above that EMA 20. So it'll be telling tomorrow and then especially Monday, we will see if we can break through that EMA 20 or if we will bounce off of it. If we bounce off of it, we're going to want to see it go back above that EMA 8, though. Otherwise, we're not going to get too excited about it. So we'll just, if we look at QQQ, that gives us more clues. So the QQQ came in and hit this horizontal level here. There's a little bit of support, but really it's not that much, and it could come down and touch that MA50. If it does, the implication is that the SPY will break and it will start heading towards that 540 level that we outlined earlier, I think 2 days, yeah, 2 days ago. So it is looking more likely that we will go down and touch that MA50 rather than just bounce off of this EMA 20. Oh, we want to see it actually happen. We don't want to jump ahead of ourselves and start predicting, but we just want to prepare ourselves in case it does start moving down. Now, because of that, we're going to hang on to our VIX hedge. Our VIX went up huge today, ending at 16 and went as high as 1643. And we were gauging for our VIX trade, the example VIX trade that we've got. We were saying, hey, well, if it makes it all the way to 17 today, we'll go ahead and get out. There's probably more to go, but that's a safe exit. Since we had this huge movement in the VIX today, and that means our VVIX is accelerating. Yeah, see, we got a big bar on the VVIX. Until I see flattening of the VVIX, I'm going to just keep on assuming that we're going to head upwards. So let's take a look at this right here. That VVIX pulled back on April 16th. Let's see what that correlated with on the VIX. So you see that? So VIX also pulled back a little bit on the 16th, and then it tried in one last go, and then it started to come down. So that VVIX is going to lead a little bit. It's going to lead by a little bit, and see that VVIX just came straight down, whereas the VIX kind of made one last hurrah before it came down. So the VVIX is going to give us a very good clue. If I start seeing a slowdown in the VVIX, then that'll give us a pretty good clue that the VIX is going to slow down. So for now, I'm going to move my target up to 18 for tomorrow in case we do bust through that EMA 20, but on the SPY. But if we pull back and we just come back to the high of yesterday or even the close of yesterday, then I'm not going to cry over it. I'm just going to keep that VIX on because we still do have a strong potential for that SPY to come through below this EMA 20. It just might not happen tomorrow. We'll have a much better idea after options expiration, of course. But for now, we just want to say, hey, okay, that VIX didn't hit 17 today. It got pretty close. If it hits 18 tomorrow, then I'll go ahead and get out of it. Or I might even revise my target up to 20 or 21. But for today, I'll just say 18. And if we don't hit it tomorrow, then most likely I'm going to revise it up to 20 or 21. For now, we'll just say 18. Let's take a look at what led this. The SPY, let's see, is down 0.75%, and the QQQ is down 0.45%. So that means that the SPY is down more than the QQQ, and that means that it wasn't just the semiconductors, it wasn't just tech. It looks like there was some participation in broader sectors. So let's go ahead and take a look at the Dow Jones. Yeah, Dow Jones, it went parabolic, and we're saying, hey, that's a little too much. It's going to come down soon. We don't know exactly when, but it should be coming down. It started to, but it still has a good bit to go if it's going to continue mean reverting at the very least to this EMA 8, but a little bit more likely to either the top, these highs right here, or to the EMA 20. And those two levels may be at the same level by the time it comes down there. So we are getting a broader sell-off today than we had yesterday. Let's take a look at our small cap stocks. Yeah, same thing. We peaked out yesterday, stalled out, and then we're continuing to move downwards today. Again, still above the EMA 8, still expecting to hit this top right here or the EMA 20, and they may be the same level by the time it happens. If we look at our ARK fund, you say that went way down, almost to the EMA 20 already. So the weakening has broadened, and that is supporting the viewpoint that it's a little bit more likely that we're going to break through that EMA 20 than bounce off of it. Let's take a look at our bonds. Let's see what those did. Bonds down a little bit, mostly flat sideways, nothing exciting right there. And then we'll take a look at one really interesting thing to know is earnings, because at some point soon we're going to start getting tech earnings. So that will have an impact on QQQ. So let's see what types of earnings we have going on today after market and tomorrow before market. So let's do today after market, any price, any sector, any current. Okay. So 16 of them. Okay. Netflix. Netflix is going to be really big. Eye surgery. Yeah, but not. I mean, it's important, especially for the healthcare sector. But the one that's going to be more important to the market it's definitely Netflix. So we'll take a look at that. And then tomorrow, before market open, American Express, Schlumberger, that's an energy company. And then same with Halliburton Energy Company, a finance company. Looks like we're going to, and then so American Express and Netflix are going to be the big ones to watch. It looks like we might have data for Netflix already. Let's take a quick look at that. Okay, initially down quite a bit. Then we recovered almost immediately, and then we're continuing to move down. We'll take a look at Netflix once again a little bit later, or as we end this video. If it stays down, then that's going to be a drag, because Netflix is pretty big market cap. Let's take a look. Top market cap, SP 500. Okay, we've got Netflix. Okay, number 27. Number 27, and that is including, nope, that's, yeah, for the S&P, number 27 in S&P 500. That's pretty high up there. So that is going to weigh down. And then how about versus QQQ? Largest companies in the USA. Okay, that's just USA. So on the QQQ, it would probably be ranked top 10. So that is going to put a drag on QQQ. And because of that, once again, that's another factor telling us that it's a little bit more likely that we are going to continue our move downwards and break this EMA 20. Again, we're not going to trade on that information until we actually see it happen, but at least we can be prepared and say, well, if it does happen, what trades am I going to go into? For example, that VIX trade, the decision was to, hey, let's hang on to that VIX trade. Now that I've seen a couple more things, maybe I don't like 18 anymore. Maybe I like 19 or 20. So I'm just going to mental note to myself, let's move this to 19. So I start to formulate my plan based on the information that I'm seeing, but I don't execute on my plan until I see the trigger actually happen. In this case, the trigger is break below that EMA 20 convincingly. Not just, oh, we not like this, not like, oh, we flitted down below it and then we traded right back up through it and then we came and touched it again. No, I want it to go down with conviction like we did through these levels. You see that? It didn't even pause. We went down through 1, 2, 3, 4, four of these purple lines before we bounced, and then we went down a little bit more, and that was pretty much it. So I want to see that type of movement through the EMA 20, which is this sea green line, instead of hey, we kind of went through and we bounced and went through and we crossed it a few times. So if I get that type of conviction move tomorrow, so for example, if we opened right where this purple line is tomorrow, and we trade down 1, 2, 3, 4 regions or 4 lines, then I'm going to say, okay, that's pretty convincing on an intraday basis. And if that holds throughout the day, then I'm convinced on a daily basis. And then I can execute on my plan. So we're just waiting. We're just waiting to see what happens when or if we break through that EMA 20, and how do we break through it. So that means I need to be a little bit, at least in the very short term, for the next few days or maybe 1 week, I should be bearishly biased. That means for me in my portfolio, because generally I'm not holding a portfolio of 1 week trades or 3-day trades. I'm holding a portfolio of maybe 2 to 4 week trades. So that means that I can take a position to the short side, one position to the short side. The rest of my portfolio should be balanced. So I'm going to start looking for opportunities to the downside and maybe just forget about opportunities to the upside for now. XLE went up today and it kind of flattened out a little bit. So again, there's nothing really that's super convincing for me to go into the upside. Same with financials. That was another one of our strong sectors. And then if I look at healthcare, same thing. Well, healthcare pulled that back really hard. So now there's nothing that I'm super excited about to the long side. And so I'm just going to play on that weakness, on that expectation that the SPY is more likely, maybe 60 to 70% chance that the S&P is going to break through that EMA 20. So where would I look? I would look in the weakest sectors. So let's see where we might find the weakest sector. Actually, before I do that, let's do the 90-day highs and 90-day lows. Today we're at 84. So this morning we're at 3 something or 300 to 96. And then the day before that, we were at 646. So you see how that pulled back. I said, okay, yesterday we pulled back to 296, but that's not low enough. And that's why we felt like there was a higher chance of us to keep on moving down today. Although we felt that probably perhaps the stronger possibility was that we would chop sideways because we didn't expect huge positioning before options expiration. But we were wrong about that one. It did come down. And so we came down to 84. And now if I look at the 90-day lows, we're still at a small low amount, only 28. 13 yesterday, 13 the day before, and now 28. So yeah, that's come down. That's making this a lot more neutral. And there's not a huge disparity right here. So that means just based on this, I'm not necessarily expecting to bust through that EMA 20. This implies, hey, we're kind of balanced over here. We're neither high nor low. We're kind of neutral, we might expect a chop sideways. But if this momentum, if we looked at the direction of this from 646 to 296 or 294, all the way down to 84, that's pretty sharp movement downwards. And if that momentum carries down to tomorrow, then we should see this hit even smaller digits and start seeing this increasing to 1 or 200 at 300. And then when we see that go above 400, then we know that that is over. So from a pure static number basis, I wouldn't necessarily expect us to bust through the EMA 20 just by this single piece of information. But when I look at that 3-day trend, there's still that possibility of us busting through because now we have some momentum behind this movement downwards. So overall, the picture is that, hey, we've got a pretty reasonable chance of moving below that EMA 20. But once again, we want to formulate our plan and not execute it. We don't want to put any orders in right now. We want to wait for this to cross definitively through that EMA 20 before we start executing on the plans. So right now we're just planning. Okay, we're planning on taking one position short. The rest of our portfolio would be balanced. Another way of saying that is I have my meat and potato trades and I have my tail risk trades. And my meat and potato trades occupy the vast majority of my portfolio. I might have, if I had a larger portfolio, just say I had a several $100,000 portfolio, $1 million portfolio, I might take 10 meat and potato trades, 1 or 2 tail risk trades, and then hedge or some really large outlier trades. So that tail risk trade should represent a small portion of my portfolio. It's not the meat and potato. It's not the thing that I'm depending on. It's the thing that every once in a while I hit a grand slam and it contributes significantly to my portfolio. That's kind of what I'm looking for. And if I lose on it, it shouldn't represent a huge loss on my portfolio. It should just be a tiny baby bit. So we're going to look for those really high reward to risk ratio trades and not really for the super high conviction but low return trades. So by their nature, the tail risk trades are less probable, but their reward to risk ratio is so high it makes it way, way, way worth it. But the fact that we have a plan and that we have something setting up in the overall market, suddenly my lower probability becomes a decent probability, but I still have that really big reward to risk ratio. So now is a really good time. Now is a great time, an excellent time, an exciting time for us to look for a tail risk trade. So I'm going to go and look in the weakest sectors right now. First, I want to see where did money move today because we saw a broader sell-off today than yesterday. Yesterday was mostly concentrated in tech, mostly concentrated in XLK and the SMH actually. And today we saw that, hey, it broadened out. It wasn't just tech today. So we saw that SMH is actually kind of flat sideways. Silver, irrelevant. Home builders, sideways. XLC, sideways. XLK, sideways. So I want to see where that big movement downwards. Financials down, but not huge. XLE up a tiny bit. XLI down into the EMA 8 or close to it. XLU not really doing anything. So far XLI, but not that exciting. XLP down a little bit, not that exciting. Down significantly on the Dow Jones, but I'm looking for sectors. Healthcare, big, huge downward movement down through the EMA 8, touching the EMA 20. So I might have a little bit of support there, but so far XLV looks like a good candidate, the best candidate we've seen so far. Biotech down significantly into the EMA 8, just below the EMA 8. The defense down into support. XLB gapping, no, not gapping, but trading significantly down into not quite at support yet. So we could have a little bit more to go on XLB. So we got XLV, XLB, XLY down strongly through the EMA 8. So that could go down to the EMA 20. It's outperforming the S&P and the QQQ, but looks like there's some room here. So XLY, XRT, very similar, came and touched the EMA 8. XRT would be part of XLY. So I'm just going to mark XLY. Real estate down just a tiny bit, and that is it. So it's looking like XLB, XLY, XLV. Okay. And so I want to think about my time frame as well. Do I want a 1 day trade? Do I want to trade over the weekend? Because if I go in tomorrow morning, unless I'm doing a day trade, I'm holding it over the weekend. So I need to think about that. Do I believe the weekend is going to make a difference? Uh, how far am I comfortable trading this to? So XLY, I'm trading it to the EMA 20 probably, even though we feel very confident about the S&P going down and the QQQ going down, but again, not immediately. So it has to fit within my time frame. So I'm looking for like a 1, maybe 2 day tail risk trade right here. So XLY is looking okay. XLB, not as much room, I would guess, before we hit a cluster of support. And then XLV is already basically at that EMA 20 support, but if it breaks through, it could hit that MA 50. Looks like my best bet is over here in XLY, maybe XLV. So we could do real quick, take a look at XLY. And then after we go through this, we'll just end it there. And you can either try to go through XLV on your own, or maybe I'll update you guys in the morning for XLV. So we're just looking for high reward to risk ratio trades. So especially if there's something that is already in a downtrend, like this Chipotle Mexican group, already in a downtrend, gap down, went down. The only thing is it's pretty close to that MA 200. So I wouldn't be too comfortable trading this at the moment. I would want to see it break through that MA 200, or I can make a plan. Remember, we don't have to put in an order right now. Our plan for the S&P was that we're going to watch and see how definitively it breaks through that EMA 20. So I can make the same plan. So since I have that type of plan for the overall market, I should probably stick to a similar type of plan for the stock that I go into. So I could just say, hey, we're going to wait and see if we see it break definitively through that MA 200, then I'm going to take a position short in CMG. Otherwise, we'll just wait until we get a definitive break. If it doesn't come tomorrow, then I can save the trade for Monday, which I'm more comfortable with anyways. So we don't have to trade right away. It's always better to wait until you have the right setup, the timing, the execution of it before, and not just kind of say, oh, I feel like I have to trade and take advantage of a opportunity immediately. So Chipotle is a good idea. We would watch it trade through the MA 200 before we entered that position. And we got some sideways ones, but I prefer a downward sloping one. So far, Chipotle looking the best. GPC, maybe this would be a test. So it traded down, retraced to the MA 50, MA 200, and then today bounced back. And this is a bounce and confirmation. That low is lower than the previous day low. We have a red bar, and that is a bounce and confirmation. So we might be comfortable going in for GPC. And for a high reward risk ratio trade, what about we just use this purple line, which is the I can't tell. It might be the MA 50 or MA 150. I can't, this line is too thin for me to see what color that is. In any case, we would just use this 145.8 level as our stop loss, and our goal would be to trade down near these lows right here. So that would be 135 or 133. And so I'm risking 5 to make either to make 7. 7 to 10. That's pretty good. That's if I go 10, then that's a 2-to-1 reward risk ratio on the underlying. And so I should have a similar or yeah, I should have a similar reward risk ratio on my option, depending on which option I choose. I can choose an option where I have a better reward risk ratio as well. For these tail risk trades, I would look for better than a 2-to-1. I would say at least 3 or 4-to-1. So we could make a tighter stop loss. We could just, but we don't want to get flushed out. But in any case, that's an example. GPC, CMG, we would wait for a trigger. Look at this one, Dominoes. It just gapped way down and traded even lower. This one's so weak, DPZ. Oh, that was on earnings. Oh, no, that was pre-earnings. Or no, I guess it was earnings. Earnings in the okay, in the morning. That sun is in the morning. So huge movement downwards, gap down. So I would do a little bit of research on normally does Domino's continue its movement after an earnings report, or does it just chop sideways or float back upwards? Domino's Pizza is a little bit more difficult, so that earnings will continue to influence it for a couple of days. So I wouldn't do Domino's. Yum looks kind of interesting. It's a little bit choppy right here, though. Here we go. Win. I just exited Win. But Win is looking beautiful. Win still has plenty to go. Plenty to go. This would be my top choice. But in our portfolios, we actually just hit a target on Win and exited because we wanted to be flat going into next week. But this is one that I'd be very, very, very comfortable going back into. So Monday, I guess I would wait for the weekend and for options expiration. But Monday, I would be very comfortable, assuming it still looks like this. I'd be very comfortable going right back into Win. But this is looking great. Win is a great, 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 beautiful. That's a perfect. That's exactly what I would be looking for. So, like this BBWI during this period, although it never really came and touched that EMA 8, so I would be a little wary of that. On Win, at least we came and touched the EMA 8 several times. So, no, we want to look for something like that. Actually, it might just, oh, here, Las Vegas Sands, similar vein. So they're both casino stocks. Same thing. This is looking beautiful. Las Vegas Sands. I might be able to do a better tail risk trade on, well, either one, actually. So if I'm doing a tail risk trade, then the position, the execution of it looks different. The option that I choose, it looks different because here, if I say, hey, maybe I'll use the EMA 8 as my backstop for my risk, and then I'll do it over here. So this could be my risk. And I'm looking for a high reward risk ratio. 3-to-1 on equity would be very high reward to risk ratio. And then I would say, okay, do we have a good chance of hitting 78? Yeah. Can we do it by earnings? Maybe, maybe not. Okay. So if we just follow this trend line, then we would expect that we could maybe hit 80 by the time earnings comes along because we don't go straight down. And that becomes more of a 1.37, 1.5-to-1 reward risk ratio. Then what I would need to do is structure my options in a way that gave me a better reward to risk ratio. If I go at the money and I give myself 40 to 60 days, or if I go slightly out of the money and give myself 40 to 60, or slightly in the money and go 40 to 60 days, then my reward to risk ratio is basically the same as the underlying. But if I go further out, if I go more out of the money, then I can get better reward to risk ratios. And then as long as I time my expiration, because if I don't give myself enough time, then the time decay will erode that and it'll eat away at it very quickly. And then I get worse reward to risk ratios. So I have to pick my expiration and my strike very carefully. And unless I'm doing spreads or a different strategy, non-single options strategies, it's a little bit easier. Actually, it's a lot easier to structure high reward risk ratio trades. But on a single options trade, you need to pick that expiration very, very well so you don't suffer that time to gain too much. And then you got to go further out the money in order to find that good reward to risk ratio. So this is an example. So I'll just use that as an example. Overnight, I'm going to be looking at the healthcare sector as well. So if you are with me in any of my portfolios, you'll probably see me issue something. Maybe I'm not going to go right back into Win because we just exited it. Win would be something that I might go back to on Monday, but it's got to be really juicy. It's got to be really, really, really good trade for me to go into it before the options expiration. That we may not get a trade at all just because we have so much higher probability if we allow the options expiration data to come in first. So we'll see. If there's something that I really, really like, then we'll do it. Otherwise, we'll just wait for Monday. So that's it for today. I will see you tomorrow morning. Have a wonderful rest of your day.